Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
Right. Welcome back to the Gentle Art of Crushing It podcast. My name is Randy Smith, and I'll be your host today. And I'm really excited to have Zihao Wang with us today. Zihao is the founder and CEO of Motiva Holdings. They're based in Los Angeles. They are a large multifamily value-added development company with over $500 million in assets under management. And they have been able to successfully provide 30% average IRR to their investors up to this point. So, Zihao, welcome to the show. Thanks for being here.
Thank you so much for having me, Randy.
Outstanding. Well, let's jump in. We've kind of shifted the format a little bit, and I come out of the gates with the big question that everybody wants to know. So, how do you see today's market impacting opportunities for the passive investor?
Yeah, I think today's market is really interesting because I see a correction in today's market from peak 2022. However, I don't see the correction being enough to hit the high teens or low 20s IRR that most passive investors saw in 2022 or want to see today. So there's still a pretty big bid-ask spread between sellers' expectations and what the buyers want to acquire. And so, for us, at least, we're underwriting a lot of deals every single week, but most of these deals don't pencil. So for the passive investor, you might see a drop in deal volume from your owner operators who you've had a great relationship with and have done deals before. But it's probably for a good reason, right? It's much better to get into the right deal than do a bunch of deals that are all wrong, right? So for the passive investor, probably deal flow is a little bit on the slow side. But if you're cautious, if you're staying in acquisition and looking for deals that fit your acquisition box and what return expectations you want, it's still possible to make the returns that you want.
Fantastic. Thank you for that. I think it's good to really set the expectation with investors that it's a different market today, and we're going to see different things in the marketplace. And not that anybody should adjust their buy box or their expectations, but having a realistic understanding of what to expect in this space, I think, is really important. The deals that we saw in 18, 19, 20, and even 21 going full cycle, long gone are those days. We are not going to see those kind of deals anytime in the near future. So thank you for that. Well, let's take a step back and see how can you talk to the audience and share with us kind of your journey, how you found yourself to be a multifamily syndicator, and some of the success you've seen along the way.
Yeah, so I got into real estate through the family. My parents made their money in the fashion industry originally, starting in the late 1900s. And then starting around 2008, they began investing into real estate in our local market in Pasadena, California. And from a young age, they wanted me to get involved. So I was involved in real estate from 13, 14 years old. And so started on the property management side, following my property manager around, learned the days in and days out of operations. Did that for 2 years before moving on to the acquisitions and capital markets side. And so today I more focus on, finding deals, finding the right acquisitions and filling the capital stack with the right debt, with the right investors and right partners. But yeah, it's been a wonderful journey. It started off in the family. It's still very much a family business and a teamwork within the family, and enjoying every day of it.
Are you interested in real estate investing but don't know where to get started or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out embarked and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.embarkedequity.net.
Love it. Yeah, so I come from a small business background too. I was a young kid running around a restaurant chasing anybody and everybody in there trying to help out. So I know what it's like as a young son of the entrepreneur to be just thrown into everything. So no doubt that that's helped to shape who you are today in the space. So now the business you mentioned, the family really kind of found their wealth, at least initially through the fashion industry, but you guys have acquired like 500 million in assets under management at this point. That is not a small feat. So can you talk about maybe some of those first assets that were acquired and what it's evolved to today?
Yeah, so we started off small, right? Like we have assets in our portfolio that are as small as 7 units. And then we also have assets in our portfolio that are over 300 units. So it's a mixture of, new capital and also 1031 capital, right? So after we do a value add strategy in a 7 unit building, we don't want to pay taxes or we want to defer those taxes. So we would 1031 into a 20 unit building, right? And after that 20 unit building, we do our value add, then we, roll it into a 50 unit or a 60 unit building. And that eventually grows bigger and bigger over time. So I mean, our family has been in the business for around 16 years now. And with our average hold period of probably 2, 3 years, we've been able to roll quite a lot of assets over the years. On top of that, we've also introduced new capital, right? So a lot of times so the operating business in the fashion industry is still active today. So we're still making a lot of income on that side. And so every year when that comes in, we invest a lot into the real estate. So as a family office, we do allocation into almost every asset class, but real estate is our primary source of investing. So in
Okay.
a mixture of introducing new capital with 1031 roll-ups has really helped us shape our portfolio.
Fantastic. Yeah, I think that strategy with your family is something similar we see with most syndicators. They generally come into the space with some type of wealth from something. Very very infrequently will you find somebody who doesn't have a successful track record before they get to the space because this is a very hard industry. Like you don't just jump into this and find success out of college or high school or something like that. So I think it's interesting how you guys have leveraged that 1031 process. And that's a strategy that passive investors can use as well. Am I correct in saying that?
Yeah, I think there are it depends on the structure of how you structure the deals. I
Yeah.
think if you invest in like a syndication via SPV, then you can follow the owner operator and invest into, new deals with that operator. But if you invest more towards like a Blackstone fund or like a REIT or like one of
Yep.
those bigger names, mega funds, then they typically don't have the mentality of 1031 or rolling up into a different asset. They more just want to return your capital and then close out the fund and start a new one. So it depends on the structure that you invest in, but it's definitely an option for passive investors.
Yeah, and I'm glad that you made that differentiation between the Blackstones and the REITs because that is one of the biggest advantages of investing in alternative investments through syndication is this strategy of 1031. I like the term they use, the follow along with the operator. So this idea that say you invest 100 grand and we turn it into 200 grand over the course of 3 to 5 years, you can actually put that 100 grand in gains into the next deal with that same operator, hoping they have a next deal.
Right.
But that is also a reason why you want to work with a group that's larger and not just kind of a one trick pony that's going to do one deal and jump. You need to place those dollars with that same operator. So finding an operator that's going to be around for potentially decades. And like yourself, Zihao, I mean, I suspect you'll be doing this for 25, 30 plus years based on the age that you came into the business. So thanks for making that differentiation. So you guys have primarily been buying in Los Angeles Metro or MSA up to this point, but I believe you guys are starting to spread your wings a little bit and look at other markets. So what kind of drove that decision and what type of markets are you looking at today?
Yeah, so primarily we've been investing along Southern California's coast, right? So we did some in Los Angeles, we did some in Orange County. We're looking into the Inland Empire, looking into San Diego. But we've also branched out into Florida and North Carolina before, and we're looking into Texas right now. And the primary reason for that is because of certain challenges when it comes to navigating the California markets. So one of which being rent control. Everybody kind of knows about rent control and is something that's in the back of their mind when they're investing in California. But for us, we're local, so we actually know how to navigate rent control. It's more about being spread too thin here. So in California, you'll see assets kind of below 100 units typically. That's just how the way like land was constructed and zoned in this area. And so for us to build a 1,600 unit portfolio, we've had so many properties that we've had to manage. And we only have so many people on our team, right? So our team members are spread really, really thin across all these properties. Whereas if you go to Texas, like Dallas or Houston, you'll see 200 unit properties, 300 unit properties, where you can actually hire one set of staff for that specific property, which, aligns their focus, but also doesn't spread your team that thin. And so from an operations perspective, we really want to, in order to scale our portfolio bigger and bigger, we felt it was necessary to buy these bigger assets in the areas where these bigger assets exist and are very common in order to scale our portfolio. So that's one of the reasons. And the second reason is I came into the business with the hopes of kind of institutionalizing what the family already had, right? So before it was majority family money. But in order to grow into, having, instead of $500 million AUM, having billions of dollars of AUM, we need to leverage other people's equity. Right. And so most investors, not just like the, small check writers, but also the private equity groups and the family offices, they prefer to operate in more Republican areas, right? So Texas, North Carolina, Florida, and all these areas where rent control doesn't really bother them at night. And it's really hard to pitch the local presence idea to these people. So in order to kind of reach my goal of institutionalizing what we already have, it's also necessary to make that step. So I think for these two reasons, we've really been looking into Texas specifically and trying to find deals that fit our acquisition criteria and return expectations in these markets.
Yeah, I think that's a trend you see with a lot of these folks, that a lot of the groups that I work with that actually are headquartered in LA at some point, or in Southern California at some point, they have to kind of spread the wings and look into other markets. And they're generally going to those same markets that you just mentioned, Sunbelt, Smile States, whatever those are. This idea of rent restriction, though, is clearly you guys have been able to create a really successful business even dealing with California political environment. So I'm curious, what kind of lessons have you guys learned? What kind of strategies do you guys lean on when you're in California market that have allowed you to be as successful as you are? Because many people just can't make it work in those markets. So I'm curious what you guys are doing there.
Yeah, so right now, one specific strategy we're using is something very unique to California, which is the big loss to lease upside. So in California, because of rent control, if you have an owner that's been asleep at the wheel for a few years, there's a pretty big loss to lease gap. For example, our most recent acquisition in Downey, you actually know about this deal, but we had about a $500 loss to lease because the owner was an out-of-state owner who hired a Boston-based property management company. So not local at all, right? And didn't really know about the rent control whole landscape here. And so we had rents that were $1,600. And for those vacant units, when we went in, we got them at $2,050. So there's about a $450 to $500 just pure loss to lease, right? Same condition of units, same size of units, everything's the same. In Texas, you can't find this because the very next year you can just roll everybody's lease to market, right? So the loss to lease is much smaller. But for these buildings who are rent controlled, you only get 5% plus CPI. So it's going to take a few years before you can actually hit market, and market keeps on going up with rent growth, right? So this is a really interesting strategy because over 5 years, let's say, if we keep hitting them with annual maximum allowable rent increases, we eventually will get to today's market rents. And that will be the $500 loss to lease, right? In Texas, you're probably getting $200 loss to leases. Over here, we can get $500 of loss to lease without relying on rent growth, right? It's just bringing rents to today's market, which will probably be a little bit lower than 5 years later. And so this has been a strategy we've been implementing to just capture the loss to lease. Very easy for underwriting because you know what rent bumps you can do, and then also you're not relying on rent increase like rent growth year over year. So for this Downey deal specifically, we bought it at a 5.4 cap, which is very similar to what Dallas is seeing today, kind of in the low to mid 5 ranges. And then, we're pushing it to about a low 7 cap through our rent increases. And then we're going to exit at a 5.5 cap. So that's a strategy that's worked really well for us and still is doing very well. So.
Well, to me, it's interesting because you hear a lot of people hear rent restriction and they get scared of that. But where else do you see 5 to 6% year over year rent increases without having to do a value add strategy? Generally, you're looking for 2.5 to 3% on a performance. So if you can get double of that without even having to do the renovations, that to me sounds like a winner. Now, I know you guys have also done some other strategies, and I'm not sure what you call it. Is it an ADU strategy or kind of a mixed development strategy? Can you talk about that a little bit too? You shared a project with me during some time we spent that I was super impressed with. Can you walk through that?
Yeah, so California has a major housing supply shortage, right? So you have demand that's here and you have supply that's here. And because of zoning restrictions, you can't really push supply the way you can do in some of the more Republican states, right? And so because of that, California has been really supportive of something called an ADU, which is essentially if you have any kind of additional space that can be turned into a unit. It can be a garage, right? It can be a laundry room, right? It can be a clubhouse, or it can be just empty land, right? And this is really good because you're doing new development without having to go through the whole entitlement process, right? Typically, when you build something new, you need to do entitlements, you need to do public hearings and draw all these complicated plans. ADUs is basically new development, but at a much smaller scale and a much simpler process. And so we've really been able to leverage that. For example, one of our other projects in Anaheim, we bought it as a 44 unit building, but we were able to build 12 2-bedroom ADUs on the property, increasing our density by 30%. And we built those for about 170 to 180,000 per unit. And, we're getting 2,600 in rents. You apply a 5.5 cap on it. You're probably going to sell for north of 300,000 a unit. So you get some additional cash flow and you also get, the appreciation at the end.
Yeah. So that is, that's powerful. So you're talking 14 units, you're driving 120, 130 grand per unit in value to that project. I'm curious with these, because you've got a number of new units and then you've got some older units on there. Do you see any challenges with marketing those assets? Do you have to market them like the older units are X price and the newer units are a different price? And is there challenges with attracting tenants because it is maybe a different profile between the two different units? Does that come into play at all?
So typically when you have when we build these ADUs, we're not really building it to class A level. We're building more still to the workforce housing level, right? So we're not, it's not as amenitized as a class A building, right? So you're not seeing like dog parks or you're not seeing like gyms and stuff like that. So our rents are still a little bit lower than a class A building, even though they are new construction. And that's reflected in the construction costs as well, right? They typically 2-story duplexes and wood frame structures. So a different level of construction for sure. When we market it though, like we definitely try to tell people that it's, new construction, right? Because the insides are all new, right? The plumbing is new, the electrical is new, they're up to code, right? They're up to kind of the standards of 2024 instead of maybe a 1960s or 1970s. So you definitely get the benefits of lowering your repairs and maintenance costs and other expenses. But on the revenue side, I would say we're still not at the class A level. It's still maybe like class B kind of product.
That makes sense. And it's a certain type of tenant that is looking for that type of an asset without all the amenities, I would imagine. In fact, I would suspect it's probably people probably stay in those units longer because of the type of units that they are. Very interesting. Okay. Now, as you guys are looking into these other markets, I know you and I have been working together for call it 6 months or so. You've had some challenges finding new opportunities out of state. Can you talk to that? Because it's the passive investor sitting on the sideline who might have only seen 2 or 3 deals in the last couple of months compared to a dozen a week. They're probably wondering why we're not seeing more deals when everybody's talking about the blood in the streets and this huge opportunity that's coming. Why are we not seeing more deals from operators like you guys?
So in terms of the blood on the streets, we haven't really seen the level of distress that we want to see. We know a lot of loans are not gonna are getting defaulted. We know there's a lot of cash in or cash neutral refinances, but the lenders are really working with operators as much as possible, right? They're extending their loans. They're hoping that operators can somehow get a lifeline, right? So
Mm-hmm.
that kind of foreclosure that we saw in like 2008 just isn't happening in today's market. Lenders are working, with operators, and also the regulations are different, right? You're not seeing subprime mortgages. You're not seeing people with no down payments or really low credit. It's a different environment. But more on the kind of value add side, at least what I'm seeing in areas like Houston and Dallas is the loss to lease over there is naturally small, right? You see between $50 to maybe $200 a loss to lease. So that's typically what, a value add play looks like, right? You're capturing maybe a $200 loss to lease. But we've seen a really big wave of supply going into these markets that have been pushing rents down, right? So your $200 loss to lease might only be $100 now. And then your $50 loss to lease might be $25 now. And so because of that push in rental softening, it's really hard to make deals pencil in terms of upside. And then sellers haven't really gotten into this mindset yet, right? So they're still kind of living in the 2022 environment where, rate or 2021 environment where rates were super, super low and rents were growing and all of that. So they still have the expectation that their property is worth X price, when right now with our current macroeconomic conditions, it's really worth X minus Y price, right? And that delta Y
Sure.
is why a lot of deals aren't penciling in our side.
That makes sense. That makes a lot of sense. Yeah. So, we just saw the Fed drop rates 50 basis points. Who knows what we're going to see just after the election? I'm hearing maybe 25. Some are still saying 50 basis points, maybe a total of 75 before the end of the year. What do you see in the coming year, both from an economic standpoint and kind of the outlook for the multifamily space?
So I think, 25 is probably my guess. I don't think they're going to go that aggressive with another 50. I think they made their kind of statement that they're on a mission to, drive inflation down and it's going to, but then also recognizing that they don't want to push the economy into a recession. So they've kind of made that statement, and now it's probably going to be, more follow-ups to that rather than keep on making those kind of statements. I do believe multifamily isn't going to see that much distress. It's a very safe asset class, right? The
Mm-hmm.
affordability story and the supply and demand story is still very, very in favor of multifamily and of renting. So I think the asset class itself has great fundamentals going for it. Yes, there are cycles up and down, but we're in correction zone right now. So, with more units being absorbed in these, highly built markets, I do believe we're going to see rent growth, in the upcoming, years. And then also, we got to understand that we're underwriting deals at a time when, it's kind of in winter times, rents are supposed to be a little bit softer than they are in summer
Mm-hmm.
times. So, the time of the year where you underwrite deals also matters, in terms of your projections.
Interesting. Yeah, I've not heard that as an answer to this before, but it makes perfect sense. Well, very good. Well, anything else that I should be asking that I'm not asking Zihao about the business and what you're doing and what you guys are excited about?
Oh, I would just add because we also do a little bit of ground up development stuff. Right
Yeah,
now that side of business is very very slow. A lot of the places that are easy to build are seeing kind of high construction costs, and that's number one. Number two, rental softening, and then three, like insurance just out of the roof. Like Florida insurance, with the
sure,
new hurricane, it's just crazy, so it's uninsurable. So that side of the business has really taken on a pause for the last 2 years, I would say. And I don't see that coming back that quickly. I know there's still some stuff in the pipeline more for, in the entitlement process for breaking ground in a few years later. So I would
sure.
say if you're kind of an investor looking for that ground up stuff, you're probably going to be sitting tight for a few years. Um,
Okay,
and then if you're more on the value add side, more activity.
interesting. Yeah, no, and thank you for adding that. It's an interesting space. I think that cost of capital play comes into play quite a bit with that as well, and that has caused some challenges, which we all know in 25 and 26 we're going to see less and less hitting, new stuff hitting the market. So that will help in the value add space as well. So we're all very eager to see that kind of come into fruition because it's been a tough year or two, no doubt. So
Right.
well, very good. Well, yeah, this has been an interesting conversation. It's neat to see the progression of your family business and how you've evolved. You now are starting to work with family office and retail investors as well. Um, if there are folks that are listening today that are interested in connecting with you, what would be the best way to connect with you?
I'm very active on LinkedIn, and you can probably also find me on my website, www.motivaholdings.com.
Fantastic. Fantastic. Well, very good. Well, I do have a few questions I'd like to ask everybody before we wrap up. So if you've got a couple of minutes, we'll jump into those. Okay. So the whole goal of this show is to help educate and inspire the new or newer passive investor. And education is a really, really big piece of what we're trying to do here. So if you were to offer a piece of advice about getting educated in passive investing, where would you direct people to either start or continue that journey?
I would say join a mastermind and listen to podcasts. When you're
Okay.
just a newbie starting out, you want to hang out with people that are experienced, that have gone through what you're currently experiencing, right? And masterminds is kind of for that purpose. It gathers a group of
Mhm.
current investors and veteran investors and kind of talk about the challenges and opportunities going on in these markets and and times. And so by joining a mastermind, you're immersing yourself into a group of people that have been where you want to be, and so you can learn a lot from these people. And I also love podcasts because it's kind of a freebie way of learning as much as possible from these experienced people, right?
Yep.
You can listen to podcasts on the car, right? In the train, almost anywhere, right? And
Sure.
so it's kind of free information that very kind people like yourself are doing and hoping to educate more people about investing. And so definitely leverage that as a resource.
Fantastic. Yeah, I'm curious. So I'm a podcast junkie. I probably have 20 that are in my weekly listen, and I might get to 4 to 5 of them. But I'm curious, what's on your listen schedule or some of the top podcasts that you're listening to?
So for macroeconomic stuff, I love listening to like Wall Street Breakfast. It's just like 3 minutes. Wall Street Breakfast and Wall Street Lunch, typically 3 minutes each. They just give a high level overview of what's going on in the macro setting, right? And
Okay.
then for real estate specifics, I love listening to Best Ever CRE, that show. It's a daily podcast, typically 40 minutes each episode, where they invite on experienced owner operators or passive investors, kind of people of all sorts on their show. And you can listen to a lot of their great content. And one podcast that I've actually just fallen in love with, which you recommended, is the Old Capital podcast.
Oh, good.
Also a great podcast to listen to with a lot of informative information.
Yeah, and they definitely have a pulse of what's going on in the Texas markets that you're looking at. So glad to hear you're seeing some value in that one. And that is one of my weekly listens for sure. Well, very good. So part of this education journey is a due diligence process. So are there due diligence questions that you think passive investors should be focusing on that maybe aren't, like the, track record ones or how many full cycle deals? Like what kind of due diligence questions do you think people should be asking?
So my personal favorite due diligence question that I like to ask is, what's the biggest risk of this deal and what's the worst possible outcome? And the reason for that is because if you're talking to either a broker dealer or an owner operator, they tend to see things in a very positive way, right? They're kind of paid to be biased.
Yeah.
So, but as an operator, you're supposed to know exactly what's going to happen in your deal, right? All of the risks in your deal, what's the worst possible outcomes. And so you can really vet a sponsor by asking this question. You can tell whether they know this deal and whether they know the market well enough. But the addition to that, though, is you're setting yourself, you're setting expectations for yourself. Because when it comes to investing, you want to prepare for the worst, right? And you hope for the best, right? So when you understand what's the worst possible thing that can happen and what's the biggest risk, you're preparing yourself for the worst, right? And if you're okay with the worst, right? If you can take on the worst, then you can get into this. You'll be comfortable getting into this investment. So it's really a both two-side thing. One is vetting the sponsor and understanding the deal, but two is also for yourself knowing what you're getting into.
I love it. Prepare for the worst and hope for the best. That could be the name of this podcast. Fantastic. Yeah.
Awesome.
Well, very good. Well, a couple of fun ones here. So do you have a recent bucket list item that you've checked off your list or one you're hoping to in the near future?
Yeah, so I haven't traveled for a long time. Internationally, I travel for conferences almost every week, so I go around the US. But internationally, since COVID, I haven't really traveled that much. And so kind of one thing that I want to do is to go see the world and see kind of Europe. Haven't been to Europe at all, actually. So really want to go and see what that's like.
I love it. I think most, like 80% of the people on here either share a travel bucket list item or some type of adventure. So yeah, no, I am right there with you. And wife and I are trying to get to Germany next year and Costa Rica. So those are our two next bucket list items. So, well, very good. And our final question I like to ask everybody lately is, if you had $100,000 that you had to invest today, but you couldn't put it in your own deal, where would you put that $100,000?
I would say for me personally, I would either invest it into real estate with another owner operator or put it into real estate private credit. And the reason is because if you have $100K, you're typically in another operating business and earning another source of income. And so you're very busy with that. So you want to choose an asset class where you can set it and forget it, right? And real estate is that perfect asset class because you can see the asset. But you can't see the price of it, so you're not bothered, every single day, whether it's up and down like you are with stocks. And then also, historically, it's been shown to have great risk-adjusted returns. So that's probably my go-to.
I love it. Yeah, if you were to say anything else, I'd be surprised. So very good. Well, awesome, Zihao. This has been a lot of fun. I continue to be impressed with you and your organization, and no doubt you guys will be billion-dollar plus AUM guys in no time. So thank you so much for being on the show. I really appreciate it.
Thank you so much for having me.
Awesome. And to the audience, as always, we encourage you to continue that education journey in the passive investing space. But more important than that, we encourage you to make the decision to invest in your first or your next passive investment deal. Both Zihao and myself are convinced that once you do, you will just wish that you had started that much sooner. So thank you again for joining us today. Be sure to join us again next Thursday for another great episode. And don't forget to like and subscribe on the podcast.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.